Welcome to Chapter 3, Financial Statements and the Reporting Entity. Chapter 3 will introduce us to the concept of financial statements by opening with the answer to the question, what is the objective of the financial statements? According to the framework, the objective of financial statements is to provide financial information about the entity's assets, liabilities, equity, income, and expenses that is useful to users of financial statements in assessing the prospects for future net cash inflows to the reporting entity and in assessing management stewardship of the entity's economic resources. Simply put, the objective of the financial statements is to provide useful information for the decision-making of users. This information is provided in the following. Number 1, Statement of Financial Position, where of course you will find your assets, liabilities, and equity. Number 2, Statement of Financial Performance, where we will find information about income and expenses. Number 3, Other statements and notes to include cash flows, contributions from and distributions to equity holders, methods, assumptions, judgments used in estimating amounts, recognized assets, liabilities, equity, income, and expenses, including their nature and risk, and unrecognized assets and liabilities, including their nature and risk. Financial statements are, of course, prepared for a particular reporting period. For example, the statement of financial position is prepared as of, say for example, December 31, 2020, indicating that they exist at the end of the reporting period. Statements of financial performance, on the other hand, are prepared for the period ending, for example, for the period ending December 31, 2020, implying that the items reported in the statement of financial performance encompass only one accounting period, say January 1 to December 31, 2020. Financial statements also include transactions or events after the end of the reporting period. These are what we call transactions of subsequent events. The financial statements are, of course, prepared under the going concern assumption, which means that unless evidence to the contrary exists, the reporting entity is assumed to exist for the foreseeable future. Now, who is the reporting entity? A reporting entity is an entity that is required or chooses to prepare financial statements. It can either be a single entity, such as, for example, a company like USJR, a portion of an entity, such as, for example, a division of a company, say, for example, the USJR Basak campus, or more than one entity. In this case, the financial statements will be called consolidated financial statements if there is a parent-subsidiary relationship, and only one set of financial statements is prepared for both the parent and its subsidiaries. In cases where the parent-subsidiary relationship does not exist, and yet two or more entities wish to prepare one set of financial statements, it shall be called combined financial statements. That ends Chapter 3. Our major takeaways for this chapter are: financial statements provide useful information to aid users in decision-making. The financial statements are Statement of Financial Position, Statement of Financial Performance, and other statements and notes. The reporting entity can either be a single entity, a portion of an entity, or more than one entity. Consolidated financial statements are prepared for entities with parent-subsidiary relationship. Otherwise, if there is no parent-subsidiary relationship, it is called combined financial statements. When you're ready, I'll see you in Chapter 4, the elements of the financial statements.